welcome to Money Matters TV. I'm your host, Doug Hepburn of Hepburn Financial Advisors, a wealth management firm in Phoenixville, Pennsylvania, offering securities and investment advisory services through Cetera Advisors, a broker-dealer and registered investment advisor, member FINRA SIPC. Cetera is separately owned from any other named entity. I'd like to welcome my co-host, Ken Jordan from Princeton Morgan. Ken, tell me something good.
What's happening, Doug? Tell you something good.
Yeah.
Seems like the good news in our business is few and far between anymore. But I think I do feel from an industry standpoint in the housing market, things are going to starting to bubble a little bit. I'm optimistic for the spring market. It seems as if December might have been, fingers crossed, might have been our low.
Awesome.
We saw some applications jump company-wide. We saw applications jump in January over December pretty significantly, and then again in February over December pretty significantly. But as a whole, we're still facing massive inventory shortages,
right.
And I think that's really the issue at hand, as we've been talking all along. Really, rates could drop, rates could go up, but there's no houses to buy.
Right. Well, I know we just found out today that mortgage applications fell for the third straight week. So, it's going to be.
They've dropped 5.6% over week, 44% drop over year, 44% drop in mortgage applications this time last year.
Wow.
Yeah.
Now, granted, some of that is probably a distortion, I think, because people saw that, the gravy train was over on low interest rates and everybody wanted to refinance, right?
Yeah. I mean, 74% drop in refinances year over year. So
huge.
Yeah. It's just, those are big. And rates were 2.625% lower last year. So we're from, low fours at this time last year to the mid to high sixes now.
Well, I guess the Fed is having its impact that it wanted. I mean, to really kind of slow things down and keep people from spending money they didn't have. Right.
I guess. I mean, there's still in our area, there's still a lot of bidding wars. There's still multiple offers on properties. I think that the Fed, with their quarter of a point raise recently is what do they say? They're decreasing their increase. So instead of going any higher, they did the quarter. But I look at the jobs number that came out in February, right? Employment is still at a crazy low level. I think that there's still too much money in the economy. And I think that we saw that little rate dip in February.
Right.
That kind of increased demand a little bit. And pushed us right back into that low inventory, multiple offer situation. I think that once sellers can see 6 inches in front of their face and predict what's going to happen, I think they'll be more apt to put their houses on the market because they know, hey, I go to sell my house now. I know what my payment's going to be on the new house. But with the volatility, it's so hard. All I keep saying is we just need stability. Doesn't matter what the rate is. Just make it stable.
Exactly. Well, some of that information is going to be good news to people I know, because I know people who are looking to sell their properties, and their biggest concern is selling into a market where interest rates are high, and that may cause some price erosion. Mm-hmm. I'm sure it's caused a little bit, as we talked about previously, with seller assist in some purchases. But it'll be interesting to see how the spring market turns out. And that's really just starting this month, right?
Yeah. I mean, they usually say Super Bowl Monday is when spring market starts. And we're starting to see that, with the application levels that are up. Pre-approval numbers have really been high all along. But really right now it's about contracts, and, we're starting to see them, tick up just a little bit, which is fantastic.
Well, that's good news, and we've had some other good news, and that I'd like to share. One is, the City Economic Surprise Index is at a 10-month high. Now, what that means is that economic indicators have been better than what the consensus forecast is. So either the consensus forecast is unusually low or the economic data is unusually high. Now, obviously, this is subject to revision, but it's good to see that the economic indicators are actually beating the forecast. Hopefully, the forecasts weren't just overly pessimistic and setting the bar low. Other good news, to some degree, is that retail inventories are up 12% from a year ago. Now, if you're a retailer, that's probably not a good sign. But I think it's kind of a mixed picture, because for a couple of years, post-pandemic, we were dealing with these supply chain issues, and people couldn't keep stuff on the shelf. They couldn't get the inventory. Now inventories are starting to build, and the question is whether or not those inventories are rising just because the supply chain is catching up, or because people are not buying as much. Now, obviously, if they're not buying as much, that's an indication that we have less money chasing too few goods, which means that inflation may in fact be rolling over. And we've seen that play out in some of the economic data, which is why the Fed has gone from 75 basis points down to 25 basis points in their hiking regime. Another piece of information that may add to this is the fact that durable goods orders declined faster than forecasted. And this could, again, just indicate that people are, kind of pulling back in fear of a recession, not buying big ticket items. And durable goods are those things that are expected to last 3 years or longer, like a car or truck, or machinery and equipment. And so, that's may not necessarily be good, because obviously we want people buying durable goods, because the multiplier on that and the number of jobs that it creates is positive. But again, the economic markets have been so distorted because of the supply chain. I mean, we hear stories all the time about car manufacturers who built cars with everything except for the chips, because they couldn't put the chips in there.
Couldn't get them right.
Now the chips are being put in the cars and put out on the floor. So, but I've got a client now who's been waiting for a couple of months for a brand new truck, and he's on the wait list. They can't tell him when it's going to come in, but when it does come in, they're going to call him and say, "Hey, you ready for this truck?" And he's got to come up with the money. So interesting times we're living in.
It's a double-edged sword. I mean, investors, they don't want to see inventory. They don't want to see, things like that sometimes. But as a consumer, those are positive leading indicators that, that the inflation may be, like you said, turning over. But, as an employed person, unemployment's another number that they're going to need to see tick up in order for us to really truly see that inflation is in check. So
exactly,
it's a constant double-edged sword that we're analyzing these numbers.
Well, and if inventory ticks up, then potentially those retailers could start discounting more. And I've actually seen that in certain areas of the economy where, these supply chain disruptions finally caught up. Manufacturers have too much inventory, and now they're doing some significant discounting just to move inventory so it's not on their balance sheet.
Yep.
So, that would certainly be a good indicator when it happens. Yeah, interestingly enough, we have a question from one of our audience members, Norma Suda of Philadelphia, asks, "What are some tax advantages to real estate?"
Whew. I feel like they're asking the wrong guy here, Doug. But I could say, there are definitely, tax advantages. Interest for a lot of people is tax deductible, which you can, obviously write off against some of your tax liability. But why don't I turn that over to you? What are your thoughts on that? What are some of the tax advantages of real estate?
It's a great question, Norma. And with any tax question, the first answer is always, it depends. It depends on your situation. If you are in a situation where you're taking the standard deduction, whether it's, single, married filing jointly, or had a household, depending on how much your real estate tax and your interest payments are, you may not even get a tax benefit for it. That said, the fact that the standard deduction was raised so high and the quote unquote tax benefit went away does not mean that for personal residential real estate, you shouldn't have your own house because it creates stability. It just means that, there's no incentive to go out and borrow to buy. Certainly as you're in higher income brackets, you've got more deductions from a personal level. Having that interest in the real estate tax deduction can be beneficial. But again, under current law, you're limited to $10,000 for state and local tax deductions. So that becomes a limiting factor there. That said, when you get to rental real estate, the tax benefits can be huge because if the property is rented out and you have income from it, you get to deduct depreciation, you get to deduct all your repairs and maintenance, you get to deduct the interest on there, and it's actually an operating business. The fact that depreciation is really just the slow expense of your purchase price on the property, and it's really a non-cash expense, means that you can actually operate at a loss, even though you're cash flow positive, and use that loss to offset ordinary income to some degree. And again, talk to your tax advisor about that because obviously everyone's situation is going to be different, but a lot of people are very successful with rental real estate. You look at a lot of moguls and they've done it, whether it's been in residential real estate, commercial real estate, or retail. It really depends on the market. And the other component is, buying as a long-term investment. There's some people that get into land banking. They'll buy large pieces of land and hang on to it and just capitalize the taxes instead of writing it off. They add that into their cost. And over time, when they go to sell the property, it's a nice big capital gain. As long as you hold it for more than 1 year, you're going to be taxed at whatever the capital gains tax rate is for that year, whatever your capital gains tax rate is. So there are benefits to it, but again, it comes back to your personal situation. If you have a question for Money Matters today, here's how you can get that answered.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, it's springtime and taxes never seem to go away. And this is tax time, tax season for a lot of people, including most CPAs. So I'd like to welcome our guest today, Nick Yzzi, who's a CPA as well as a former IRS agent. Nick has been in taxation for many, many years, is a wealth of knowledge, and is going to update us on a lot of the things that he's seeing in this year's tax prep season. Nick, how are you?
Very good, in spite of tax season, Doug. Good to be here.
Yeah,
with you and Ken.
It's funny. I talk to a lot of CPAs, and on the one, we talk about double-edged swords. On the one hand, they love tax season because it's great revenue, but on the other, they hate it because they're packing 12 months of revenue into 3.5 months. And it's having, as a recovering CPA, I know what it's like just to try and get all the returns out the door. Hopefully you're not doing that.
To a lesser degree than I did in the past, but yeah, it's still a hectic time of year.
Yeah. Having that work-life balance in public accounting is tough from in the first quarter. First quarter. Are there any new tax laws that have affected the 2022 individual tax return season for you?
There's not a lot that affected 2022 specifically, but There are many that are coming in that are significant that are going to start to be affected for 23, and that was the Inflation Reduction Act was largely a non-tax bill, and there were two major pieces there. There were a lot of energy credits, and some of those will affect 22. Some start in 23, but you had the vehicle energy credits that were expanded, and now manufacturers like Toyota and Chevrolet, they lifted the 200,000 unit ceiling, so those electric vehicles are now eligible for the credit that can go as high as $7,500. You can now buy a used vehicle that's electric, and that would also be eligible starting 23 for the energy credit.
Even if it's used.
Yes, that's new starting in 23.
You know, that's fascinating, because typically, you know, the federal government likes to give a tax benefit the first time you buy something, and once you got it, it's
Correct.
gone.
Correct.
So now the same car can actually generate two credits, right?
Yes, as long as you buy it from a dealer, can't sell it to another family member. And then there were some other energy credits for homeowners and businesses. There's a bunch of them. We'll just mention two for homeowners, and that's they had it in the past: insulation, exterior windows, energy efficient appliances like heaters, air conditioner, boilers. There's a 30% credit with a max of $1,200. But there's also a residential clean energy credit, which is for solar, wind, geothermal that produce heat or electricity. That credit has no cost limit, so you can get a 30% credit on an unlimited cost. And that retroactively does go back to 2022. So if you're in a project that maybe spans 2 years, or you've already done that for 22, you'll be eligible for that credit.
Wow. And now, is there an expiration date on those credits?
No, not currently.
Okay. So until they change the law again, you're good, right?
Yes. Until the next administration comes in and messes with the tax laws.
Yeah. So they pull the rug out from under you.
Yeah. The other interesting thing was the Secure Act too. The Secure Act had to do with many retirement provisions that started in 2019. But for 2023 now, they raised the required minimum distribution, which is the time period you have to start taking draws out of your pension plan, IRA, 401k. So that age has been increased to 73.
Yeah.
For years it was 70 and a half, and then they raised it to 72 under Secure Act 1, and now Secure Act 2, it's raised to 73. So you can do that. You can always delay your first RMD to April 1st of the following year, but if you do that, then you're going to have 2 RMDs in 1 year. Right. And also, and if you don't take a retirement distribution, there's an excise tax that was historically 50%. That's been reduced to 25%. So that's a good change as well. The other part of the Inflation Reduction Act was the more controversial thing was the IRS funding. And, the news reports about 87,000 IRS agents being hired, and they're going to carry guns. Let me just put that in a little bit of perspective. Congress did give them a huge allotment of $80 billion over 10 years for a variety of endeavors, and the largest piece is compliance, which is going to be examinations. And there haven't been a whole lot of IRS audits over the last 10 years. It's been maybe 1%. So that will increase. But what you have to remember is they are replacing 50,000 retirees over the next 10 years. So they're not all going to be auditors. There's a variety of other employees that they have: collection division, taxpayer service, IT, administration, secretaries. But the interesting thing is they're not carrying guns. I think that was picked up because the criminal investigation division, those agents, they're called special agents, they carry guns because they deal in fraud.
Sure.
So yes, are there other IRS agents that carry guns? Yes. If we had more time, I'd tell you a couple stories as a former agent, but we don't have time for that.
I can imagine.
Nick, let me ask you this. I mean, obviously the increase in capacity that they're trying to improve upon capacity, which is a good thing. Where is the IRS right now with regard to unprocessed returns? I know that was an issue last year. Is it still an issue this year?
It's less of an issue, Ken. When we entered tax season last year, and here's the holdup: it's paper filed returns, 1040s, business returns, amended returns. When we entered tax season last year, they had 11.5 million unprocessed returns. As we go into this tax season, they're down to 1.4 million, which is still too many because they're prior year's returns, and now they're into a new tax season. So it's better, but I mean, here's the lesson from that. there are 13 million 1040s to get filed by paper out of a total of about 168 million. You need to file electronically if you can, because that will expedite your tax return and your refund. And IRS has already predicted that you can get your refund in 21 days if you file electronically and you use direct deposit. I've seen people get their refunds in 4 or 5 days after it was filed.
Wow.
So one of the things you need to do is not file by paper to the extent you can, because you can always free file too. If you have AGI of less than $73,000, you can do that and not have to file by paper or fill out a return by hand. The other problem has been the phone assistance. And it's interesting, they received 173 million calls last year, and they only answered 13%. And that's called a courtesy hang up. Now, if that was your business and you hung up on 70% of your clients, you'd be out of business a day or two.
Oh, the Yelp reviews would be terrible.
Yeah.
I'm pretty sure the IRS Yelp reviews already are in the 20s.
Yeah. And even for practitioners that sort of have a special line where they can contact the IRS if they have a power of attorney, only 16% of those were answered. I mean, I've called maybe 20 times on one client to resolve an issue with the taxpayer priority service.
Oh, I believe it.
It's getting better. They've hired 4,000 people recently to help with phone assistance, but they're still behind as well on correspondence. It was taken over 6 months to respond. If you got a notice from the IRS and they said, "Hey, we show a 1099 from your financial provider that you had dividends, and we don't see it on the return." If you respond to that in writing, it was taking them 6 months. In the meantime, the process kept churning, and you're getting more threatening notices, and sometimes a threaten to lien your assets.
Yep.
So they eventually did stop that because the Congress got involved. But
Yeah.
it was a mess last year. Hopefully, it's going to get better this year.
Yeah, I've seen that happen. Once the great computer in the sky starts, gets these messages, it starts churning out letters, and it just doesn't stop.
Correct.
And those aren't the letters you want to. One, they're not the ones you want to get, and two, they're not the ones you want to ignore, because oftentimes they have deadlines of 30, 60, or 90 days. That if you don't respond, too bad, you're SOL, so to speak. So what can a person do to save taxes, if they're over 72? I know you mentioned that you've got the Secure Act raised the RMDs to 73.
Yeah, I'd say two things, Doug. One of them is a qualified charitable distribution. When you're required to start taking your RMDs at age 72, and it really coincides with what you said earlier. Because of the large standard deduction, many folks can't itemize their deductions, so they're not getting a benefit from their charitable contributions.
Right.
So if they're charitably inclined, it would be better to pay their charitable contributions by having those funds go directly from their IRA to the charity. And what happens, you don't get a deduction, but it's not taxable income, and it reduces your AGI, and it also helps you with the IRMA adjustment, which is your AGI that affects your Part B premiums and Part D for Social Security. That can go from $165 a month to $561 a month. So it helps that, but also helps if you have high medical bills. Because of the 7.5% threshold, you may not be able to take medical expenses if your AGI is too high. So what it does is it lowers your AGI because it's not being reported as income, because it's going directly to charity. And another thing you can do too, if you're still working and collecting, if you're still working and you're receiving RMDs, you can also, as of 2020, contribute to a traditional IRA to offset that RMD income that's coming in. So there's two techniques there that you can do to eliminate some tax or at least reduce it when you're receiving RMDs. So people receive RMDs, and sometimes they don't need it to live on. So they prefer not to do it anyway, but you don't have a choice.
But you got to have the right fact pattern. It's not going to work for everybody.
Yeah, you're going to have earned income to be able to deduct a traditional IRA.
Yeah.
If we still have time, I had a question, Nick, about the PA Educational Improvement Tax. Can you give us some background on that, on what it is and what the benefits are?
This is an amazing credit. It comes under Pennsylvania, and it basically gives a tax credit to an individual if they commit to make contributions to a scholarship fund that they can earmark for a specific private school, let's say. And what you do, it's like making an estimated tax payment for Pennsylvania. Instead of going to the state, you're going to get a credit that you take on your tax return of 90%. So let's say you made a 2-year commitment of a $5,000 scholarship contribution. You're going to get 90% of that, or $4,500 tax credit on your return. So let's say you're making estimated tax payments, $4,500 divided by 3.07%, which is the Pennsylvania tax rate. You just shoulder and pay taxes for $146,000 of income.
That's huge.
So it can reduce or eliminate your Pennsylvania, or just create a refund. It could reduce your tax requirements for estimated payments, or produce a refund. It doesn't cost you anything, and that other 10% is also deductible as a federal deduction. So you want to look at
benefit to the schools too, and
it's absolutely, because some of these schools, they're able to keep the tuition down because many of their students are eligible to participate in this program. It's a great benefit. It wasn't always available for individuals until the last few years. It's also available for businesses.
Yeah.
So it's a tremendous credit, and there's not a limit on how much you can contribute. But
the leverage,
it's
there is huge.
Absolutely.
The leverage is huge.
Absolutely. So as long as it's in the law, and I'm surprised that it still is, to be honest with you, it's just a great opportunity for someone to take advantage of.
No, that's good. That's good. Well, I know we're coming close to the end of our time here, but I did want to mention, I keep getting these calls about employee retention credits. You see this everywhere, and
radio and
yeah.
Employee retention credit is, and the ads are all over. And to be honest with you, a lot of those are just, we call them ERC mills, employee retention mills, that crop up because they see an advantage. And unfortunately, many of them are not doing these applications correctly. And it's already estimated there's $2 trillion worth of illegitimate refunds that are being generated because of ERC mills that IRS is aware of. So if you're going to do this, do it with your tax advisor. But just real quickly, this is a fantastic credit that you can take advantage of as a result of COVID if you retained your employees. And technically, if you look at it, you have to compare your revenue. There's 2 criteria, a revenue criteria and a closure criteria. And if you meet those criteria, you can get a credit for as high as $26,000 per employee, as long as they make at least $10,000. So when you look at that, I've seen businesses and done some of these. And the other thing too is it applies to nonprofits, and it also applies to churches. And I've seen churches get these credits, not huge churches, but modest-sized churches. They're getting these tax credits for $100,000 or $200,000. So it's absolutely something you need to look into. The statute of limitations for the first quarter will be coming up on April 30th, but there's still time over the next year or two to be able to do these credits for businesses and nonprofits that kept their employees. And it mounts up. And in the definition of wages, when you calculate that credit, that definition also includes health insurance that you pay.
Yeah, that's pretty broad.
So it's something you need to look into. If you're in business, don't discount that, but be careful who you hire to do this, because you don't want to be in a situation where they say you're eligible, because you have to analysis quarter by quarter, and there's 7 quarters involved. The 4 quarters of 20 and 3 quarters of 21. The first 3 quarters.
So be careful.
Be careful.
Words to the wise. Be careful.
Use someone that you're familiar with.
Watch out for fraud. Yeah. Well, Nick, thank you so much. This has really been informative. We appreciate your time at this busy time of the year. Our guest next week is going to be Bill Dunkelberg, Chief Economist for the National Federation of Independent Businesses. I've heard Bill personally speak, and he's fantastic. Hopefully you can tune in for that. And we look forward to seeing you next time on Money Matters TV, where your money matters.